Hello, everybody, and welcome to the Tradition Mortgage Podcast. My name is Mike Greenlay. My co-host again is Erik Hendrikson, and our special guest today is Brad Carlson. He's a senior vice president and partner with Tradition Mortgage, and we will get to Brad in just one second. But before we do, Erik, there's obviously the upfront portion of the mortgage market that most consumers will see. Whether they're buying a home or refinancing, there's a lot of things. There's rates, there's loan officers, there's people they deal with on the front end of things. But there's the other side of the mortgage industry too, where a lot of the gears are working and a lot of the things are happening that people don't see. Can you give us a quick little synopsis on that side of the business and what they do?
Sure. Thanks, Mike. Glad to be back again. Yes, what I really wanted to talk about today is just the kind of behind the curtain. Consumers, when they're looking at mortgages, they look at the rates and fees, and they want to take advantage of the best possible opportunity for themselves to put themselves in a great financial position, and that's wonderful. But behind that, there's a tremendous amount of details and minutia that really go into each and every mortgage. And I think that there's a lot of, I don't want to say misunderstanding, but really a lot of just no understanding at all by the average consumer out there as to just how complex it really is behind the scenes to really ultimately deliver to them these conventional mortgages. And I think it's important to remind people or teach people that, really these loans that we're selling to the consumers out there, they're products that are created by some big government-sponsored entities that go by kind of the nicknames Fannie Mae and Freddie Mac. And these entities were created many years ago, really by the U.S. government to really provide low-cost home mortgages to U.S. consumers. And at the end of the day, those entities create the guidelines necessary for an individual to qualify for that mortgage, for those mortgages. And it's even more important to, remind people that these really low rates that we enjoy are because of these entities that the U.S. government has in essence created for us, because what they're doing is using the kind of the implied faith and credit of the United States government to be able to go out there and borrow money on the capital markets and take that money. That's exactly what is put out there for all these mortgages. So when you go borrow money, you're not necessarily borrowing from a bank long term. You're actually borrowing from investors on the capital markets that are looking for a nice, safe bond with a long-term return. So these are what's known as mortgage-backed securities. So it's pretty deep minutia, but at the end of the day, when people complain about all the paperwork that's involved and they don't like it, you got to remind yourself that, well, if you didn't have all that, you wouldn't get these really, really low rates out there. And at the end of the day, it's not your friendly mortgage bankers that are creating all these difficult guidelines. It's really these entities that have created those guidelines because they believe that's ultimately what's going to put kind of the best, highest quality mortgages in place out there. So anyways, it's a deep dive. We're very fortunate in the United States to have a mortgage-backed security kind of platform that does give us access to incredibly low-cost capital that we can go out and buy homes with and refinance. We're very fortunate of that. Doesn't mean it's perfect, and certainly it's frustrating. And if Brad Carlson and I could devise up our own underwriting guidelines and programs, I'm sure we come up with what we feel is a bit of a better model for putting loans in place. But at the end of the day, really what an independent mortgage banker is, they're just kind of I always say like they're the river raft guide. We don't put the boulders in the river. We just help guide you around them safely. And really from an operational standpoint with mortgage companies, our job is to be able to take that loan application and get that through to closing as quickly as possible and as efficiently as possible for our consumers. But there are a lot of steps there, and ultimately how well you can execute in taking care of those steps, that's what makes a mortgage banking company successful.
So we'll bring in Brad Carlson, who's not the bad guy. He's not the bad guy, nor are the people that work around him. But you guys have to deal with the, sometimes people would call it the minutia or the details, or the rules and all the regulations and whatnot. And everyone in the housing and mortgage industry has experienced such an incredible surge in activity that they've never really seen. And it's required kind of an inward look by all these companies, including Tradition Mortgage, to find ways to deal with the volume. And, so what did operations have to do, or what did you guys do over the past, for sure 8 months, but maybe longer, to try and streamline your process, or at least get it to the point where you guys could handle the amount of volume that you guys have had to experience?
Yeah, thanks, Mike. And like Erik had mentioned, we're all playing by the same rules. Nobody's doing anything different as far as the groundwork of the rules. At that point, it's how you execute. Mm-hmm. And that's one of the things that Tradition Mortgage has really focused on. And as you mentioned, especially over the last 8 to 12 months, it's really tested. Even us who pride ourselves on our execution, on how to get these loans through the system, get them through so the least amount of resistance, and ultimately get to the closing table. And that's just something that we really dedicated ourselves to, especially over the last 12 months. And we put a lot of systems in place, and it really comes down to the professionalism of the staff. It's understanding that you have the people in the right position, people that understand how to work the system, people understand and dedicated to their roles. And for us, that's where we excel, is making sure that we have the right people, the professional people, the people that are dedicated to do their job and make sure that we can get these loans through the system in a timely fashion, which ultimately is the best benefit for the customers.
So as things continue to evolve, things continue to change, and markets continue to move, you guys have made maybe or starting to make a pretty good shift now from what was a very, very heavy refinance market now into more of a purchase market. Can you kind of give us a background on that and what changes that means for you and your department?
Yeah, you bet. Purchase, obviously, on the purchase side, we're at the means of the purchase contract on as far as the timing of these, and right now in the market that we're in right now, we're trying to put our borrowers in the best position as possible, and a lot of times that results in short turnaround times on our purchases. And once again, that's the things that Tradition Mortgage excels at, making sure that we understand the situation, making sure that we put our loan officers in the best position to ultimately help their consumers get to the closing table. And for us right now, purchase is our priorities, and we do what we have to do to move those to the top of the forefront and make sure that we're working with not only the people that have to be involved on the purchases and keeping them updated, but also working with our third-party people, our credit agencies, our the insurance agents, making sure that everybody is working within the same timelines that we are to make sure that loan gets done in time.
Yeah, Mike, one thing I would talk about as we do transition from what's known as kind of the refinance boom market to a purchase money market is that you really do operate, like Brad said, on some very defined timelines. When you're working on a refinance with a client, they're in a current mortgage, they're in their house already, you want to get that loan done for the customer as quickly as possible, but whether it closes one day earlier or a few days later, ultimately at the end of the day, as long as you've worked together and communicated, it's kind of all good. But on a purchase transaction, oftentimes, it is a relatively short window, especially in a very competitive marketplace where a seller of a home is maybe going to accept an offer that has a shorter time frame because they want to close and get their money. And then we, as a mortgage banking company, have to do everything we can to make sure we get that loan closed on the date that's shown on the purchase agreement. So definitely, we have to make sure we have all of our ducks in a row. It goes into having very, very experienced loan officers that on the pre-approval process, they've done exactly that. They've talked to the customer, they've gotten a full application, they've got all the income documentation, they have them pretty much buttoned up and ready to go. So when an offer is accepted, it's a matter of really, getting a title report, getting that appraisal in, maybe getting an updated insurance binder, and then really lining that thing up for closing. One thing, and certainly Brad can speak to this, in much more detail, is in addition to our good friends at Fannie Mae and Freddie Mac and what they've created for underwriting guidelines for a loan to be eligible to go into their programs, we have the federal government and the regulatory bodies that have come up with significant additional requirements related to every single home mortgage that we need to abide by. And these are very hard, fast rules, and there are certain periods of time. We have what's known as a loan estimate that needs to go out that breaks down all the details of a loan. And then prior to closing, you have what's known as the closing disclosure, which has replaced the old settlement statement, and that needs to be accurate and signed 3 business days in advance. And then you have the actual consummation closing disclosure. So needless to say, there's a lot of arrows that have to be lined up to meet a successful closing, and you do have a lot of parties that are involved in the purchase money transaction. You have the buyer, you have the seller, you have real estate agents, you might have a builder, very interested parties that are waiting to get their paycheck, so to speak. So again, when the rubber meets the road, we want to be showing up on closing day with all the documents in order and the wire sent to the title company on time.
And Erik brings up regulatory or those types of situations where a certain body is going to say there's a certain way to do things, and you even mentioned it earlier as well, Brad, that we're all following the same rules, and well, sometimes the rules change. They change for everybody. You guys have had to deal with that here recently as well, something that hasn't really occurred in a while, but it just seemed to land. I mean, I don't know, I don't know if it's a good thing or a bad thing. I mean, when everything's up in the air, maybe it's a good thing to throw a few more things up in the air, but you guys have had to deal with the pretty big transition on top of the volume that everyone is seeing. You guys got some more regulatory things. Can you kind of just dive into that a little bit? I mean, it's not the kind of details that people maybe want to listen to too much, but you guys did have to deal with some regulatory issues.
Yeah, it's not a glorious change, but it's something that the whole industry had to deal with. We all dealt with the first change in the last 25 to 30 years. I believe that we went away what's called from the old 1003, which was the traditional mortgage application, to switching over now what's called the URLA, the Uniform Residential Loan Application. And it was a big adjustment, not so much for the consumers, but for internally, for all the companies. It was dealing with new software changes, procedures on what we had to do. So you throw in one of the busiest times that we've seen in the industry and for over the last 2 years, and you mix in a new process that we haven't seen in 30 years, it made for yet another change. But once again, as we mentioned before, we're all playing by the same rules. It's the same changes that everyone else had to go through at that point. It's how you execute, and that's, again, where tradition excels. And for us, it was one more challenge to focus on and make sure that we were on top of our games and making sure we're taking care of our clients.
Yeah, and I can attest to, as the president of the company, seeing how our operational staff reacted and really got on top of a lot of these internal changes that were required. I mean, it's hundreds of hours that Brad and his team put in training our entire group on how to, use the new forms and make sure we had them correctly. Because the loan application is the beginning point of the whole process. So that part, if you don't have that correctly figured out, everything's off track after that. So you have to execute perfectly on that front end, and that flows into so many other pieces that ultimately result, if you do it right, into a successful close. So I mean, just again, on top of just amazing amounts of volume, all of a sudden, you create a whole new input form that really drives the whole rest of the mortgage process. Not to mention, when you talk about, not so much regulatory, but underwriting guidelines with the COVID pandemic, Fannie Mae and Freddie Mac, the two big juggernauts that really control all the guidelines for these conventional loans, these rates you see advertised everywhere, the programs that are the vast majority of what we sell, they came out, during the pandemic, and they made it much more scrutinizing for especially self-employed borrowers, because they're looking at, their small businesses may be impacted negatively in the pandemic. So just a tremendous additional amount of underwriting guidelines for those of you out there listening that were self-employed and refinanced. You can speak to that, but updated profit and loss statements, multiple months of bank statements, really just a higher level of scrutiny. So again, you have thousands of loan applications coming in every month, and all of a sudden now you have, in some cases, 2 to 3 times more of the documentation that you need to weed through to get a loan done, and then throw in the fact that we have a very new and complicated loan application that's part of the whole process. So needless to say, this is not a part-time job. When you're in the mortgage operational world, man, you got to be dedicated to it, and you have to be constantly, educating yourself and studying all these changes. It is just, it's amazing how much more complex this mortgage process is compared to just even, 3 or 4 years ago.
Yeah, no question. I think if you have a situation where you see that's part of it bogged down, you realize very quickly that there's the other side of the coin here. And to your guys' credit, that doesn't happen very often, if at all, with the way you guys deal with those things. You know what? I wanted to just throw this one last little thing out there. Obviously, the pandemic, it gave us a world where we couldn't really predict too far ahead because there's a lot of moving parts. Now, as things are maybe going in the right direction, do you find that you are able to, I don't know if they use the word predict, but look forward and say, okay, well, we think things are going to go to this direction or that direction. Do you find that you're maybe getting back into that a little bit more, or is it still kind of like dealer's choice because it's tough sometimes? Yeah,
I would love to say that I'm more comfortable with consistency coming, but I think there's a lot more changes yet to come with the new presidential administration in there. One of the big hot buttons is regulatory enforcement, and certainly looking at equality in lending and other things. I think that you're going to find there's going to be more guidance about how lenders go about their business practices, and that just has ripple effects across the industry as well too. And also Fannie Mae and Freddie Mac, again, these are two juggernauts that represent 75% of all mortgages that are closed out there, and the government may be long-term looking to have them kind of reduce their overall involvement in the mortgage process. And we've seen them kind of stepping away already from non-owner occupied loans and second home, kind of the vacation home loans as well too. So I think there's going to be more of those things to come. So I think that, again, I say it in all the podcasts, stay athletic, stay in an athletic position, be ready to pivot and move and stay on top of things. I think, from a standpoint of, where our interest rate's going, I think that, hopefully the movements will be relatively limited in scope. We saw a big bounce up last month, and now we've kind of stabilized. But I do think over time, we're going to see that drift upward as well too. But hopefully, again, it's in a controlled basis that it doesn't leave anybody kind of hanging out there. But this business, the only constant is change, and all you can do is just make sure you're doing everything you can to stay abreast of all the guidelines, all of the different pieces out there that, again, may be changing on a day-to-day, week-to-week, month-to-month basis, so we can give the best, accurate advice to our clients.
And kind of a similar question to you, Brad. You guys don't have to pivot as quickly as maybe some people are on the front lines, I guess if you want to call them that, because you guys you have your systems in place. You know what you have to do. There typically aren't a lot of surprises. Would that be correct, or do you guys have to sometimes pivot on a dime?
No, we still pivot, and again, for the operational side, our job is to make sure we're putting our loan officers in tradition in the best possible position, to help our clients and make sure that we're meeting their expectations, especially in this new world that you talked about with the pandemic right now. It's making the housing market very competitive, obviously with the shortage of homes, which everybody's hearing about. For us, it's making sure that we're managing that pipeline, those loans that are coming in, and making sure again that we're on top of that and putting our LOs and obviously with our borrowers' best interest in mind, making sure that we continue to meet those quick closing dates that are popping up more and more today.
All right. Well, gentlemen, appreciate your time. Thank you very much for stopping by. Brad, good to talk to you. I know we'll probably run into you a little down the road here as things continue to change, but I appreciate your time as well.